Thank you, Riyadh. Good morning, everyone. Before I even start the presentation, let me ask, can you see me? Because the podium is slightly higher than I am.
No, we see you.
Brilliant. Right. So in today's session, what we are going to do is, over the next hour and a half, we walk you through an overview of key concepts under Oman VAT. We then walk you through key developments since implementation in April 2021. Then we talk about VAT positions in key sectors, moving on to some procedural reliefs which have been extended by the tax authority, the experience of compliances, next steps for businesses or taxpayers who are likely to be affected by VAT, and then we wrap up the session with Q&A. We request that we park the Q&As till the end, because that way we'll be able to go through the content of the session. But if you think it's extremely pressing and you want to ask your question, then put your hand up and we'll try and take it then. Riyadh has already introduced the speakers. So let's jump into the presentation, start with the overview of Oman VAT. Now, what is VAT imposed on? What is the scope of the tax? VAT in Oman, like any other GCC country, is imposed on taxable supply of goods as well as services. It's also imposed on the import of goods or the import of services into Oman. When we say taxable supply, it includes two types of supplies. There's standard rated supply and there's zero rated supplies. Now, I know these concepts may sound new to you, but on the next slide, we'll give you an illustration of what we mean when we say a standard rated supply or a zero rated supply. VAT is not imposed on exempt supplies, and again we'll explain the concept in greater detail. Now, while there are transactions which qualify as a supply, and supply usually includes provision of goods or provision of services by one person to another in exchange for a consideration, and the supply is in Oman. That's what's considered as a taxable supply in usual VAT parlance. But VAT also extends the tax to certain transactions where these essentials may be missing, but for the purposes of the VAT legislation, it is still deemed to be a supply. And these are usually examples where you've purchased goods, you've incurred a VAT on the purchase, you've recovered input VAT credit, but then you decide to supply it free of cost. Or you purchase goods, you recover input VAT credit that you've incurred on the purchase, and then instead of applying it for business purposes, you apply it for non-business purposes. In those instances, you may have certain fundamentals of VAT like a consideration or a recipient missing, but for the legislation or in the eyes of the Oman Tax Authority, you've incurred a certain VAT on the purchase, you have recovered the input VAT credit, now you've made a commercial decision of distributing it free of cost. That doesn't mean that that should dent the revenues that the tax authority would have been able to collect on this supply, and therefore these are deemed to be supplies in the eyes of VAT authorities, and they would still want either a VAT collected on the supply by giving it a deemed value, or they would require you to reverse the input VAT that you've incurred on the purchases. So those are some of, so that explains the concepts of where VAT is imposed in Oman. Now, while that is supply that happens, that is an onward provision of goods or services by a supplier to a recipient, as I mentioned, VAT is also imposed on import of goods or import of services into Oman. Now, import of goods is very simple. You have an overseas supplier of goods, someone who transports the goods from overseas, you clear it through customs, you bring them into Oman. Now, the logic is that if you had purchased these goods from within Oman, you would have paid a VAT on the purchase. So, to ensure that there is equality in the application of the legislation, when you import goods into Oman, technically you pay VAT at the time of customs clearance unless you've applied for a import VAT deferral. So that's how VAT is imposed on import of goods. On import of services, similar to, and this is not strictly the equivalent, but similar to withholding taxes, when you have a service provider who's overseas, who provides services to a customer in Oman. And the customer in Oman is the person who's registered for VAT. The tax authority has recourse against the person in Oman. The tax authority will not be able to, or with great difficulty, will be able to go behind someone who's not in Oman. So, in case of import of services, where the supplier of services is located overseas, the recipient is in Oman, and the services are provided, received and consumed in Oman, the place of supply, as we call for VAT purposes, is in Oman. It is the responsibility of the person in Oman who is registered for VAT purposes to account for this import of service, to account for VAT on it and report it on their returns. And often certain businesses may miss withholding tax obligations or miss VAT obligations. Going forward, it's extremely important that businesses align the position on both, because the tax authority administering both in Oman are the same. Moving on to the next slide. Now, I've used certain concepts repeatedly and they will continue to be used during the session. So, let us give you an example of what we mean when we say standard rated, zero rated or exempt supplies. Now, when you look at this illustration, we are looking at this from a taxable person's perspective. So, a taxable person in Oman purchases goods from a vendor. The purchase price is 100. The taxable person has incurred VAT of 5%, so that's 5 in VAT. The taxable person uses these goods to manufacture something which is again standard rated or taxable, but this is only one of the many components that goes into the goods, let's say. So, the taxable person eventually sells the final product at a sale price of 300 to the customer. Since the product is standard rated, the taxable person calculates VAT at the rate of 5% on his sale price, which works out to 15, and therefore, at the end of the tax quarter, when the taxable person looks at his overall tax position, assuming this is the only transaction that's conducted, there's output VAT on the supply the taxable person made to the customer, that's 15. There's input VAT, which the taxable person incurred on the purchase that it made, so that's 5. The net tax that the taxable person needs to pay to the tax authority in this example is 10, because the 5 which is collected by the vendor will be paid by the vendor to the tax authority. So, overall the tax authority gets 15, the taxable person gets an input credit of 5, the taxable person has to pay 10 to the tax authority, which is actually recovered from the customer. As an indirect tax, this is a tax which the taxable person is only an intermediary for. He usually doesn't pay it out of his own pocket. It's indirectly recovered from the customer and then paid to the tax authority. Now, how is this different from, let's say, a zero rated supply? Similar concepts, again similar supply chain. Taxable person makes a purchase price 100, 5% VAT works out to 5. Now, the taxable person uses these goods this time, let's say, to make a zero rated supply, export of goods. In this case, sale price is 300, but because the supply is zero rated, the output VAT is 0. So, in this case, at the end of the tax quarter, the taxable person's overall tax position is output VAT 0, because it was a zero rated supply. Input VAT that was incurred on the purchase is 5, but because the output VAT is 0, the taxable person now has a refund, and in order to claim the refund, the taxable person can either go to the tax authority and demand a cash refund, and for that there is a different process, but this can be sought as a cash disbursement or reimbursement. The other alternative is that the taxable person uses this to carry it forward to the next tax quarter. If in the next tax quarter the taxable person has an output liability, this input VAT can be set off against future output VAT liabilities. Now, I hope I am audible at the back. Am I audible at the back? Now, exempt supplies, which is the outlier, and when we looked at the scope of tax in the previous slide, it only includes taxable supplies. it does not include exempt supplies. So what are exempt supplies? Same supply chain. In this case, the taxable person purchases goods 100 reals, incurs input VAT of 5 reals, but the taxable person in this example uses the goods to make a exempt supply. Sale price is 300, but because the supply is exempt, there is no VAT on it. This is different from a zero rated supply. How? Because it's exempt, the taxable person is not able to recover the 5 input VAT that was incurred on the purchases. So when you look at the taxable person's position at the end of the tax quarter, output VAT is 0, input VAT is 0, the net VAT payable is 0. But in the commercial world, what this would mean is that the taxable person's purchase cost has increased by 5 Omani Riyals because the input VAT is a cost, and therefore for all commercial purposes the taxable person would want to pass this on to the ultimate customer, and in the ideal market circumstances where the consumer is willing to bear the cost of this, the sale price would then become 305. If the sale price still remains 300, that means the taxable person is paying for the input VAT out of his or her own pocket. How do we know whether a transaction is exempt, zero rated, suspended, or out of scope? The general rule is, if the transaction is not eligible for a special treatment, it will be standard rated. Now I'm going to pick on the crowd now and I'm going to ask, what is a standard rated supply? Anyone? Right. Sorry, I didn't mention I would be asking questions. Right. So a standard rated supply, as I mentioned, is where the supplier has to charge 5% VAT and is able to recover input VAT that is incurred on the purchases used to make the supply. There will be more questions coming. That was just a warning, an easy one. So unless a supply is specifically eligible for a special treatment, which is exemption, zero rating, suspension, or it's treated as out of scope, the legislation says it will be standard rated, which means you will have to pay a 5% VAT on it, regardless of whether you have the commercial ability to charge it from your customer or not. So how do you identify whether a transaction is eligible for a special treatment or not? The legislation sets out transactions which are eligible for a special treatment. Exemptions: financial services, resale or lease of residential properties, bare land, healthcare services, goods and services related to healthcare, education services, goods and services related to education, local passenger transport. All of these are eligible for an exemption. Any special treatment comes with a small asterisk, conditions apply. So make sure when you're looking at treating a certain transaction specially, you look at the conditions, satisfy them, only then apply the special treatment. Zero rating: when the supplies are within Oman, supply of crude oil, oil derivatives, natural gas, goods and services related to crude oil, oil derivatives, natural gas are zero rated. Supply of goods or services to, from or within special zones, specified food items when supplied, specified medicines and medical equipment, international transportation of goods and passengers, goods and services related to international transportation of goods and passengers, supply of means of air, sea and land transport for commercial purposes, supply of rescue planes, rescue and assistance boats, and investment gold, silver and platinum. All of these, when supplied within Oman, are zero rated. When a supply is made from Oman to overseas, it is also eligible for zero rating if it qualifies as an export of goods, it qualifies as an export of service. Now, the supply of goods or services is otherwise exempt in Oman and is supplied from within Oman to overseas, and supply of goods or services in certain customs suspensions. So these are examples of exemptions or zero ratings. There is also a suspension. What a suspension means is, till the conditions of the suspension are qualified or met, the VAT which would otherwise be payable is not payable. But if the person who's claiming the suspension stops meeting the conditions of the suspension, then the VAT would be applicable. So for example, when you import goods into a special zone, till the conditions of the suspension are met, you do not have to pay a VAT on it. But if it's released from the suspension, the person who's importing would have to pay the VAT that was otherwise due. So import of goods to a special zone is eligible for a suspension. Import of goods under a customs suspension is eligible for a suspension. Common examples of customs suspension is import for re-export or temporary admissions. Now, certain transactions, although they may have all the essentials of a supply for VAT purposes, are also specifically treated as out of scope. Which are these transactions? These are transactions where the supply is made, but the place of supply according to the VAT legislation is not in Oman. If the place of supply is not in Oman, then the Oman tax authority does not have the jurisdiction to charge VAT on it. It perhaps falls in someone else's jurisdiction. If the supplies are not made in the course or furtherance of business, then these may not be subject to VAT, they may be treated as out of scope. When the supplies are made by a person who is not registered for VAT, and when I say not registered for VAT, they are correctly not registered for VAT. Just for the sake of completeness, when a business makes, and the business could be any form, it could be a proprietor, it could be a company, an LLC, an SPC, a SAOC, SAOG. So any person who's in the usual course of business making certain supplies for the purpose of generating income, which is why I said individuals could also qualify as taxable persons. When the value of supplies made by them over a period of 12 months exceeds 38,500 Omani Riyals, they are required to register mandatorily. Anyone who's below 38,500 Riyals is not under the statutory obligation to register. But businesses that make taxable supplies above 19,250 Omani Riyals can register voluntarily. So just to simplify this, anyone who's making taxable supply or the value of annual supplies is up to 19,250 Omani Riyals over 12 months is not eligible for registration. Anyone who makes whose value of annual supplies is between 19,250 to 38,500 has the option to register. Anyone who makes whose value of annual supplies is in excess of 38,500 has to register. So anyone who is not registered correctly for VAT, the supplies made by them are out of scope. Supplies made between members of the VAT group. So unlike corporate tax, where every business has to register separately, VAT gives businesses the option of creating VAT groups, multiple entities under one single VAT registration, which means one single VAT return, one audit, one assessment, one payment. But there are conditions that members of the VAT group need to satisfy. These are usually businesses that are commonly held or controlled. So subsidiaries, group companies, but you need to look at the conditions. When supplies are made between members of the VAT group, they are not subject to VAT, they are outside the scope of VAT. Transfer of business on a going concern and settlement of claims between the insurer and the insured. With that, very quickly, key developments in 16th of April. As a snapshot, in terms of decisions, we've had decisions on registration. As I said, the threshold for registration, mandatory registration as well as voluntary registration was prescribed. Because the Oman Tax Authority wanted to give businesses time to register and prepare for VAT, initial registrations were also phased over a period of 1 year. But effective 1st of April 2022, all businesses that meet or exceed the monetary threshold are now required to register. The phasing ended on 1st of April 2022. So those are a couple of decisions. There were decisions on food items which are eligible for zero rating, a list of those. A decision on medicines or medical devices which are eligible for zero rating. We'll get into the details of these subsequently, and some of these decisions have been amended over time, so those decisions. There have been guides which have been issued by the tax authority, sectoral guides, there have been procedural guides, and in the next section we'll walk you through key positions which are endorsed by some of these guides. And then there's other decisions or press releases or information that is put out by the tax authority. One of the important decisions in this is the treatment of supplies made to government bodies. Now often we are asked by businesses if there is a special treatment for supplies made to government bodies, and this release on the tax authority's portal said that supplies made by a taxable person to government bodies is not eligible for any special treatment. They are treated just the same as a supply made to any private business or individual. But when we look at some of the positions that are taken in the guides, we will see that the tax authority in some ways deviates from this decision. With that, let's move on to the next section. Sorry, just jump to the last page. So first we start with the key positions in the oil and gas sector. Now this is based on the oil and gas guide which was published by the tax authority. Now it's also important to understand the working or the division of the oil and gas sector, because the tax legislation, the VAT legislation in Oman prescribes special tax treatment for crude oil, oil derivatives and natural gas and goods and services associated therewith. If you saw on the earlier slide, these are eligible for zero rating, but conditions apply. So the most important condition is that the zero rating is available only in the context of supplies which are for upstream or midstream activities. These are not eligible for downstream activities. You may ask, how does one know whether activities are upstream, midstream or downstream? That's clarified by the guide. Again, this is illustrative in nature, this is not exhaustive. So what the tax authority says is upstream activities are activities that are essentially related to searching for potential hydrocarbons. These will include your geophysical activities, it will include processing of hydrocarbons to separate gas, oil and water. It will include your construction or lease of facilities for upstream operations, storage tanks and facilities in the field, and abandonment as well as decommissioning is also included. So it's the entire life cycle of an upstream activity. Midstream activities are essentially activities related to the gathering of unrefined hydrocarbons. By way of illustration, they say this is transportation of crude oil via the MOL or via the gas network, storage of raw hydrocarbons, not refined hydrocarbons, and the liquefaction of natural gas to LNG. What's downstream activities is activities related to conversion of hydrocarbons into refined products like petroleum products, and the transportation and storage of finished products of hydrocarbons, that's your petrol and diesel as you and I as consumers use it. So as I mentioned, there is a zero rating which is available for supply of crude oil, oil derivatives and natural gas, as well as goods and services associated with supply of crude oil, oil derivatives and natural gas. This comes with conditions. What are those conditions? The supply has to be directly and exclusively for use in upstream and midstream activity, which means if it's indirect or if it's capable of being commonly used, let's say for midstream and downstream activities, the zero rating will not apply. The second condition is that the supplier and the recipient are both taxable person, right? Which one? This one. Supplier and recipient are taxable persons. I'm still audible at the back, right? Okay. When we say taxable person, it means a person who's registered or required to be registered for VAT purposes. If any one of them is not registered or required to be registered for VAT purposes, the zero rating is not available. Then the next condition is the supplier and the recipient are registered and licensed by the Ministry of Energy and Minerals. Now, what does registration with and licensing by Ministry of Energy and Minerals mean? This caused a lot of confusion initially, but in the guide it's finally clarified that when it's a supplier, a registration with the Joint Supplier Registration System is sufficient to qualify as registration with MEM. So far as recipients are concerned, a list of operators and partners who are engaged in upstream and midstream activities as well as small field operations is prepared by the MEM and shared with the tax authority, and that in itself is sufficient for registration with and licensing by MEM. And the last condition is, in order to qualify for the zero rating, the supply should not be such that is blocked for input VAT reduction, listed under Article 25(5), which is essentially your recreational items, or is exempt from Oman VAT, if you remember the list of exempt supplies that we saw on the earlier slide. When I say blocked for input VAT deduction, 3 items are specifically blocked for input VAT reduction. One is food and beverages or catering services, motor vehicles which are available for personal use by employees. It doesn't have to be actually used, even if it's made available for personal use, it's blocked for input VAT credit. So that's one of the conditions that you will need to look at. And sorry, the third is the entertainment services. Scope of entertainment services hasn't been defined, but if you look at the rest of the GCC, that would usually include hospitality, which is not the usual course of business. So your iftar lunches, iftar dinners, in some cases certain off-site activities, recreational activities. Now, in addition to these conditions which are already a part of the legislation, the guide requires or clarifies that in order to be eligible for the zero rating, the operator, the recipient, has to give a declaration that the goods or the services which are being procured at zero rate will be directly and exclusively used for oil and gas activities, and specifically upstream and midstream activities. So here the operator takes the onus of communicating or undertaking to the supplier that the supplies are eligible for zero rating. There is certificate by the supplier which needs to be submitted with the tax authority at the time of registration, which is the JSRS certificate, for the tax authority to know that the supplier is also eligible for the zero rating. And lastly, it also clarifies that supplies made by subcontractors to contractors who then supply to operators, in this supply chain, the supply by the subcontractor to the contractor is not eligible for zero rating, because it's not for direct and exclusive use in upstream and midstream activities. There is an intermediary involved in the form of the contractor. It also clarifies that import of goods or import of services by an operator are not eligible for zero rating, because again in this case the supplier and recipient need to be taxable persons, and the supplier will not be a taxable person for the purposes of Oman VAT legislation. So those are conditions, certain specific treatment of certain specific transactions between operators and the government, supplies to or by the Ministry of Energy and Minerals. Mike doesn't like me. Supplies to or by the Ministry of Energy and Minerals are zero rated. The gas transportation tariff, also known as RAB, zero rated. Crude oil gas revenues either from the sale of gas by the government or purchase of gas by government, all zero rated. EPSA overheads, zero rated. Royalty and rent under EPSA, all of these are not subject to VAT. Training levies which are collected by operators on behalf of the government and then disbursed to the government are also not subject to VAT. These are treated as out of scope, and this is where the tax authority makes a deviation when it says that supplies by any person to government, according to the press release, deserve the same tax treatment as any other supply. But here it recognizes the concept of sovereign functions and says that when a government body undertakes certain sovereign functions, it may be eligible for certain special treatments. If we move on to the next slide, we'll close out the oil and gas sector, and then I'll ask Sumit to come on for the next, sorry, that's financial services. So I'll run financial services. The recharge of costs between JV partners or operators is eligible for a zero rating to the extent it's for upstream and midstream activities. For all other recharges, you'd have to look at the nature of the transaction. Transportation via the main oil line is zero rated. Electricity, when it's supplied between operators, is zero rated, but when it's a utility company to the operators, it would still be standard rated. Connection charges from producers or operators is zero rated. Transfers, which is transfer of business on a going concern, either partly or fully, if it satisfies the conditions, would be outside the scope of VAT, as we saw on the earlier slide. If there is a transfer of inventory, which is again crude oil, oil derivatives of natural gas, it would be 0 rated. Cash calls, when it's for upstream or midstream activities, is not subject to VAT. Any other funding arrangement, you need to take clarifications from the Oman Tax Authority or assess yourselves. And lastly, the quality bank adjustment, which the tax authority sees as a punitive or a compensatory payment, is not subject to VAT. With that, quickly looking at the financial services sector, if you remember again on the earlier slide, we said financial services are exempt from VAT. Not all financial services are exempt from VAT. Financial services are essentially services which are provided by a bank or similar operation that is licensed by the CBO or another competent authority for a consideration. To the extent the consideration is in the form of a fixed fee or an express fee, these would be standard rated unless they are eligible for certain other special treatment in other categories. In cases where financial services are in exchange for a margin or a profit, these would be exempt. Now, in the financial services guide, the tax authority has listed the different types of transactions that are peculiar to the financial services sector, and in that it clarifies that supplies between establishment of the same legal entity, which is HO and branch, are outside the scope of VAT. Now, this is not just peculiar to the financial services sector, this is also common to other businesses where there is a head office overseas and there is a branch in Oman. What the tax authority does distinguish in this is that if the head office provides the support to the branch, then it is outside the scope of VAT. But if the head office procures the services from a third party and only acts as a contracting intermediary or a paying intermediary, where the branch eventually benefits from these services, these could still qualify as import of services. The branch would need to look at implications to pay for VAT under the reverse charge mechanism. Now, in this, the general concept under VAT is that any payment which is punitive or compensatory in nature is not subject to VAT, it is outside the scope of VAT, which is why in the oil and gas sector we saw QBA is excluded from the scope of VAT. But when you look at the financial services guide, it says late payment fee or early termination fee are standard rated. These are not considered to be punitive because in this the tax authority assumes that there is some sort of service, active or passive, by the supplier to the recipient. Now, we need to remember that for VAT purposes, the scope of services is extremely wide. Anything that does not qualify as a supply of goods is supply of services, and within that it also includes a passive act of tolerating an act or non-competes of that sort. So, in the financial services guide, the tax authority actually clarifies that in some cases the fee that you recover, the nomenclature doesn't matter, you need to look at the substance over the form. But if it's a genuine damage by a court or arbitration panel, it is compensatory in nature and therefore is out of the scope of VAT. It also gives certain examples of adjustments, book adjustments, revaluations, and says that so long as this is not realized income, you do not have, there is no supply, you do not have to pay a VAT on it. But then it makes an exception for market disruption yield adjustment and says that this is exempt, which is something that the tax authority needs to clarify further. Now, interestingly, waiver of fee. In normal circumstances, you would have probably seen waiver as fee as a deemed supply because you've procured goods or services, you've made a supply for which you should have recovered a fee, but you tell the customer, I'm waiving the fee. So, there is a supply, but you've voluntarily or just to pacify the customer because there is a complaint, say that you want to waive the fee. This in normal circumstances, as I said, would have qualified as a deemed supply. But in the financial services sector guide, the tax authority clarifies that if certain conditions are satisfied, they may not deem it as a supply. Essentially, that these are in the usual course of business. You do not use goods or services specifically to make this supply, and at some point in time, you intend to recover something from the customer which will probably make up for the supply. Financial services, life insurance is exempt. Marine or cargo insurance, when it's a supply in relation to international transport of goods or passengers, is 0 rated. Other general insurance is standard rated. Reinsurance takes the same color as the main insurance. With that, I'll wrap up this section. Ask Sumit to come on for the next section, which is real estate. Thank you. I'll be back in a bit.
Sorry for this. Hi, good morning everyone. So if you go to the real estate sector, and before I come on the VAT implications or the VAT treatment for real estate, it is first important to understand what does a real estate means. And the definition of real estate could be different from what you see from common parlance. If you look at the VAT legislation and with the VAT guide which has been issued by the tax authority, assets such as bare land or undeveloped land qualify as a real estate. Any building which is attached to the ground, it could be a building, it could be an asset, it could be a furniture, any goods which are attached to the ground and which cannot be dismantled easily will also qualify as a real estate. Car parking lots which are part of the building or the land also qualifies as a real estate. But then if you look at assets such as temporary housing which can be moved without any significant damage, example like caravans, makeshift homes, those will not qualify as a real estate. Any furniture equipment that is not permanently installed to the land or building will not qualify as a real estate. Now with this and understanding what does a real estate mean, let's look at the taxability of different types of real estate. If we look at the supply and the supply of real estate, I'm broadly distinguishing between a supply of a commercial real estate and a supply of a residential real estate. If I talk about supply of commercial real estate, whether it is a sale or whether it is a rental, that supply is subject to VAT at the standard rate of 5%. If we look at the supply of a residential real estate, the first sale when the constructor or the real estate developer builds the real estate and then sell it on to the customer, that first supply is also subject to VAT. But if the buyer of that real estate, which means the residential real estate, if that buyer subsequently sell it to the another customer, that subsequent supply is exempt from VAT. So for residential property, first sale of residential property is standard rated, but any subsequent supply is exempt from VAT. If you talk about renting, now renting of commercial property, as I said, is subject to VAT at standard rate. But when it comes to renting of residential property, it could be apartments, and those residential dwellings are not subject to VAT. They are exempt from VAT. Now, one of the key conditions to get an exemption for renting of residential property is that the renting should not be for a period of more than 3 months. It should not be for a period less than 3 months, and there should be a proper agreement in place to substantiate that this is a long-term rental agreement. If you have a rental agreement for a period of say 2 months, and we have those apartments here in the country where you can take the apartment for residential purpose just for a 1 or 2 month period, that is not eligible for exemption. You will have to charge a standard VAT rate of 5% in those cases. Supply of bare or undeveloped land, as I said, is exempt from VAT. I will come to and explain you what does a bare land means, because it has its own implication from a VAT perspective. And supply of real estate located within a special zone, within a notified special zone by the tax authority, that is subject to zero rate. I will come to in detail on the supplies within special zone, but any supply of real estate within a special zone is zero rated. What are the types of residential real estate? As I said, residential real estate is exempt from VAT, but if you look at the exceptions, any hotel, while it is for residential, while it is for stay purpose of the tourist, that stay is not exempt from VAT. So any hotel stay, any tourist complex, commercial complex, which is, while for the residential purpose, those are commercial in nature. Those are not for just a residential dwelling. So those transactions are subject to VAT at the standard rate. They do not qualify as a residential real estate. Now, if I talk about VAT treatment of certain real estate related supplies, and I will start with the bare land, as I said. So bare land has been defined in the VAT law. It means a land with man-made structures, and it could be partially completed, could be fully completed, and that structure could be above the surface or could be beneath the surface. It is not necessary that you have a construction or a structure above the surface. So for example, if you have an irrigation system on an agricultural farmland, that will qualify as a construction which has been done, or a structure which has been done on that particular real estate. So that no longer remains a bare land, it becomes a developed land. If you have a road, an approach road to that plot, that plot is no longer a bare land or undeveloped land, because the construction by way of road has been developed or has been made on that plot. Therefore, it becomes a developed land. So it is important to understand that if there is any sort of development or any sort of structure which has been made on that land or that plot, to be eligible for a bare land, and therefore then eligible for exemption from VAT. Now, if you change the treatment, for example, if you give a bare land to a developer, and then you ask to develop that bare land into commercial property, for example. Now, the moment the developer starts developing that property, it becomes a developed land. So the consideration or the total amount which the landowner would have received on transfer of that bare land is then divided into two parts. First, on account of the bare land which was given initially, but any consideration which is attributable to the land which becomes developed, or when the development starts on that land, that consideration becomes subject to VAT at the standard rate of 5%. If I talk about real estate owned by individuals, if you recall, Abha mentioned in an initial slide that there is no special treatment for supplies made by individual. There is a general assumption that if an individual is giving out any property, a commercial property I will say, on rental basis, they believe they don't need any VAT registration or VAT obligation. But that's not true. Any individual who is renting out a commercial property and has an income of more than 38,500 Romani Riyal needs to be registered for VAT and charge VAT at the standard rate of 5%. Now, if it is residential real estate, it is exempt, but if it is commercial real estate, that person or the individual needs to register for VAT and charge VAT from its customer. Mixed use real estate, there could be residential, there could be some complex or apartment which are used for or which are available for residential purpose as well as commercial purpose. So for example, there could be the first and second floor of a building which is available for offices, and the remaining say 4 or 5 floors of that building is available for residential purpose. And we have seen many such buildings in the country, right? So that becomes a mixed use real estate. In such cases, if there is one common landlord, it becomes important to identify or bifurcate the value towards the commercial real estate floors, which is the first 2 floors, and the floors which are towards residential real estate, because of 2 reasons. One, the VAT treatment on your sales side. Second, the eligibility of the landlord to claim input credit. Now, if the landlord is procuring certain services, say managed service to manage the entire property, that managed service is being used to provide 1, a standardized supply of commercial real estate, and 2, an exempt supply of residential real estate. So that landlord has an obligation to apportion input tax credit which is attributable towards the exempt income of residential floats. So that bifurcation is important from a landlord perspective to identify how much is towards taxable supply and how much is towards an exempt supply. Car parking, if car parking is provided as part of the commercial real estate, it takes the same color, the same VAT treatment, standard rate. But if the car parking is given as part and parcel of a residential property, which means say you don't pay anything extra other than your rental for the residential house, then there is no separate charge and therefore there is no separate VAT treatment. So you have to see whether the charge for car parking is collected separately or it is part and parcel of the rent amount. And the same treatment will follow for any service charges, any maintenance charges which is collected over and above the basic rental amount. If I talk about services by non-resident, if a non-resident is having some real estate in Oman and they are renting it out, if it is for commercial purpose and the renting of that the renting of that property is to a customer who is registered for VAT purpose, that renting becomes subject to VAT. But since the customer in Oman is subject to VAT under reverse, is registered for VAT, and the supplier is outside the country, so the Oman VAT legislation is not applicable on the overseas supplier. So in that case, the registered person in Oman becomes liable to pay VAT under a reverse charge mechanism. But if the customer in Oman to whom that property has been given on rental is an unregistered person, that becomes subject to VAT. In that situation, the overseas supplier who is not based in Oman needs to be registered for VAT purpose. It is also important to understand and to note that if an overseas supplier is owning any property in Oman, it may also create a fixed establishment, a business establishment for that supplier in Oman to be registered for VAT and corporate tax purpose.